All right, y'all, I'm back. I'm back. So this is where we left off: real estate and rights, property investment for every investor. So the book that I'm currently reading from is 101 Investing for 101 Friendly Investing for Beginners. So this is the next chapter we about to read, and as I stated before, not as I stated, but as I put in my profile or what my bio is I read different books. We're going to read them page by page, slowly but surely. And that's where I'm at. I like to read, and hopefully this can help somebody else read and understand. I will be highlighting certain things that may strike me, you know, might strike my mind or whatever. So you're going to probably see me highlighting stuff on here as well, of the different books that we're going to read. But like I said, we're going to do things slowly but surely, page by page. And my goal is to do it day by day. So here we go. Real estate and rights. Property investments for every investor. Real estate investing means putting your money into property to earn a return, either through rental income, property value growth, or both. There are different ways to get involved with real estate, from buying a house or an apartment directly to investing in pooled funds such as real estate, investment trust, rights, which means real estate investment trust, short for rights. Each approach has its own benefits, risks, and requirements. Investing directly by owning property is the most traditional way to invest in real estate. You can buy residential homes like single family houses or commercial buildings like office spaces and stores. In residential rentals, you can often get started with a 20% down payment on a mortgage. For example, if you buy a $200,000 home, a down payment might be $40,000 plus closing costs. Once you own the property, you can rent it out and collect monthly payments. Suppose your mortgage, taxes, and maintenance costs $1,100 per month, but you rent the home for $1,400 per month. That gives you $300 per month in passive income before occasional repair costs or vacancies. Over time, the property may also rise in value, a concept known as appreciation. If your $200,000 house grows to $250,000 over 10 years, that's a $50,000 gain when you sell, not counting transaction costs. Direct ownership has clear risk. Tenants can miss payments or damage the property. The house could sit empty between renters, adding stress or lost income. You'll be responsible for repairs, paying property taxes, and dealing with issues like leaky roofs or broken appliances. These property management tasks require involvement or the hiring of a property manager, which comes with additional fees. Selling a house takes time, so real estate is not as straightforward to cash out of as stocks or bonds. That's good to know because I never knew that. Rights provide a way to invest in real estate without owning a building yourself. Rights, which we just learned if we back up. Where's that at? We just read it. Oh, here it is. Rights, which means real estate investment trust. Okay, here we go. Rights provide a way to invest in real estate without owning a building yourself. Rights are companies that buy, manage, or finance real estate and trade on stock markets like regular shares. You might invest as little as $1,000 in a publicly traded right through a brokerage account. Your money joins that of thousands of other investors, and the right uses it to buy things like shopping malls, hospitals, or apartment complexes. Shit almost remind me of Monopoly. You receive dividends, typically paid every quarter. from the rental income and profits generated by these properties. For instance, if you invest $1,000 in a REIT yielding 5%, you would expect about $50 per year in payouts, though this is not guaranteed and depends on the real estate market health, which is a risk, which I just said earlier when we started. REITs are popular because of their liquidity. You can buy and sell shares easily, unlike selling a property. However, because they trade on public stock markets, REIT prices can fluctuate quickly, exposing you to market swings. REIT income is often taxed as ordinary income, not at the lower long-term capital gains rate. So tax planning is important. Some investors look into real estate crowdfunding platforms. These websites let multiple investors pool small amounts, often $500 to $1,000, into a single project. You might help finance a new apartment complex or hotel, sharing in rental income or project profits. Crowdfunding lets you invest smaller amounts and diversify across several projects, but it often comes with less liquidity than REITs, as your money could be locked up for several years until the project finishes or sells. These deals generally require less day-to-day involvement, but carry high risk if the project fails. Real estate mutual funds offer another way to diversify. These funds invest in a mix of REITs or real estate related companies. With as little as $250, you can spread risk over a wide range of properties, and professionals will manage the investments. Liquidity is high, but like REITs, market swings can affect values. The main benefits of real estate are steady income, possible price growth, and low correlation with stocks and bonds, which can protect your portfolio during stock market downturns. Many investors appreciate getting monthly cash flow from rentals or quarterly dividends from REITs. But real estate is usually more complex than stocks or bonds and has unique risks, such as property damage or real estate market cycles that affect values. You know what? I never even thought about that, because I have a little dividend share, stock shares, and yeah, that's different than real estate. I don't even get into that. Right now, I'm on like dividend stock shares, like pieces of companies. I never thought about it, the real estate like that. Economic downturns can mean falling property prices and lower rent collections. Practical risk management helps. For direct ownership, keeping a cash reserve covers repairs and vacancies. For REITs or funds, diversification across different property types lessens risk. Understanding local real estate trends and not overpaying for a property are key to long-term success. This blend of income, appreciation, and diversification makes real estate a useful part of an investment portfolio, with options from hands-on property to easy access rights. Even small investors can take advantage of opportunities in the real estate market. So that, see there, we finished that page that quick, but we learned about REITs. And what does REIT mean? Real estate. I'm gonna go back to it so that way we can look at it again. REITs, real estate investment trust. That's what REITs is. So we're gonna highlight that. I can put this out right here. This here. So we know what that means. If you ever hear REITs having anything to do with real estate, that's what the full sentence means. The full word means. We put that in green. So we learned about this today. So let me go here. Ooh, I'm tripping. Let me push this back in here. There we go. So that's what we learned today. We read that and learned a little bit about rights and real estate trust and all that, and what's the risk of journeying or pursuing real estate. And real estate is more riskier than dividend shares and stocks and all that. Real estate is more riskier because you're dealing with brick and mortar. So your properties can get damaged, and you got to have cash flow or at least some type of reserve for if people leave and people get put out and all that, which I never thought about it like that. It would make sense though. But that's what we learned so far today. And tomorrow is going to be cryptocurrency and digital. That's going to be the next page for tomorrow. So until then, y'all take care of yourself, and I'll talk to y'all later. Thanks for watching.